Welcome to the Dividend Talk Podcast, episode 229. Our take on the best dividend ETFs for European investors. Hey, European DJ, first podcast of the year. How's 2025 been so far?
First one's the second, my friend. The
Second
first one was last week where we did the portfolio evaluation for the fourth quarter.
We did. It's a long day. It's nearly midnight here. So
no more coffee for you. No more coffee for you.
No.
No, but generally I'm good. The good week. I don't know about you, but I love it because this week the market was really tanking in many areas. I mean, tanking is a little bit of an overreaction. Maybe I shouldn't use those words, but it's clear that many stocks were going down. So there was a lot of discussion on social media. You see the posts on Facebook going up with people asking about people's thoughts about certain stocks. Same on Twitter. So for me, that's nice. It's kind of a bit popcorn time. Yeah, I always get happy when the market goes down. I don't know about you. I saw my portfolio today and I saw like, wow, a few K down, and I really got a smile on me. I felt like my blood even started to be joyful. I felt like, oh, hey, I should consider buying something here. Like maybe the candy store is having a discount coming up. Yes, Black Friday, whatever it is. But
yeah,
and makes me excited.
It's a fun time for it because earnings is coming around the corner. And it's usually annual report time as well. So
yeah, exactly. Oh, it's gonna be nice. It's gonna be nice. I mean, I really hope to buy some nice quality stocks. I'm really looking forward to it. And if you see where some of the Americans are going. Also, the dollar parity is coming up again. And by the way, I often get questions about this, right? Do you now buy more European? But I don't know about you, but what stops the dollar euro from going from 1.02 to 0.9? Yeah, it was 1.4, 1.5, 1.5, like I don't know, many years ago. So it's just been a trend. So I think it's not wise to stop accumulating in whatever you want to have exposure because you're anticipating on the currency, because maybe we will never see this currency after tomorrow again and it will only go further. Yeah, we don't know.
Of course, we don't know unless you're a seasoned FX trader and know exactly where it's going. It's hard to judge. But I mean, a lot of good companies are trading near the 52-year or even multi-year lows. Yeah. Like every time I turn on Twitter, I see Pepsi. Pepsi seems to be everywhere. Yeah. Everyone's talking about Pepsi. Obviously, you have Nike, Johnson, Prologis, Mondelez is struggling. Hershey's. I mean, it seems like there's lots of opportunities there.
Yeah, but I do get a bit tired on social media about these 52-week lows posts. Also on YouTube, all these accounts, 52 weeks lows, 52 weeks lows. And I dislike it for one simple reason. Those same influencers, they trigger a behavior in people that in other posts, when they are quoting Buffett and everything, are trying to say we shouldn't have. Yeah. So they're using the psychology of people of greed, let's say, and of thinking that there is like a discount. They use the psychology to get engagement. But at the same time, in other tweets, people will warn about such behavior, and you should have a long-term perspective. And in the long run, as stock market is a weighing machine, and so I'm quite getting annoyed by all these posts because it doesn't help the followers, and people are really promoting this kind of thinking with this, right? And I understand that maybe as a watch list, looking at the 52-week lows, you may find something, but what's a 52-week low? Yeah, what is it even? It could be a 5-year low, whatever it is, but it doesn't mean it's cheap. It doesn't mean discount. Luckily, the good accounts, they always talk about that later, but it's a lot of clickbait in the end, yeah? And I think, I hope our listeners don't fall into that trap too much to think about those 52 weeks lows. Just think about the business you want to own and then start doing your own homework. You know them for what you want to buy. And if it hits your buy range or your yield on cost that you require, you buy it. Yeah.
Yeah. It sounds so easy, but everybody is influenced by price. It triggers something. Either a
Of
thought,
course, the price matters.
yeah, it'll trigger something. So look, it's hard. I know these. People need to, with their YouTube channel, if that's their income, they need to be able to create content. And it's hard to talk about dividend stocks all the time because we don't increase dividends every single day, or there's not big dividends. So price is an easy one to capture. But you have to say, I don't know, I'm sick of talking about Pepsi. You talk about that. I see it everywhere. 3-year lows, 4-year lows, like you said. But there are some companies there like Johnson & Johnson, Mandela's, that are probably interesting to look at.
Yeah. It has been a really long time ago that they were all trading properly above 3%.
Yeah, which is what we want to see. And then obviously in the UK, we've had similar trends. We're seeing the UK struggling. They have a weak consumer. Hit Greg's. So Greg's came out with their trading update, not their annual report yet, but the trading update. And they had record sales, 2 billion in sales, which is a record, up 11% year on year. But the share price dropped 10, 11, 12, double digits anyway.
Yeah.
So why is that? And it's all down to weak consumers. Also, there was a budget last November. I think it was November. And there's this new insurance. They're not new insurance, but they kind of widened. I think I spoke about it on the podcast, but they widened the gap on who was entitled to it, and then they increased the amount as well. So it adds about 100 million to their costs. And then, look, as I said, weak consumers is everything, which means someone like Greg's have to increase their prices. But the thing about Greg's is that they are known for low prices and value. And if you increase your prices, you could alienate some of your prices.
It will hit their margin.
It could hit their margins, exactly.
Yeah.
So it's a tough one for them at the moment. It's more kind of like an economic headwinds. They're still accelerating with their stores. So Div Craft asked us, is it a buy or not a buy? I mean, in my opinion, if you can look past the economic headwinds in terms of the weak consumer and what's going on with the government and their policies, management is good. They've dropped quite a lot this week, I would say. It looks like a good opportunity to me. But again, who knows?
Are you invested in the company?
I have a smallish position, about 50 shares of them. So I have them, and it looks, personally, I probably will be buying more, but I'll have to do a bit more due diligence.
Oh, nice. Yeah, the UK is becoming very interesting, specifically those businesses that have a large international exposure, and those I'm mostly interested. Yeah, because then they go down with the general sentiment of the UK indexes.
Yeah.
So, but then because they are having a large exposure internationally, you don't really have too much of a issue then with the local economy, if that's the worry for many. So like I think British American Tobacco and such, right? Large international markets. So, and if the general index goes down, and it pushes those stocks also down, although they were holding quite well up, I must say. But those are the stocks that have my interest then,
yeah. But the ones, if you are into more value, obviously the ones that are more intricated into the local economy, the UK economy, they are really being punished, and there's obviously going to be some opportunities there. So it's an interesting market. I don't think it's quite as bad as what Trump and Musk are spouting off on Twitter about the UK. At least from my friends in the UK, I don't get that sense that it's as bad as that.
Yeah, no, but what's going on there? I mean, you call two names here. Let's
move on.
I mean,
exactly.
The Musk is a brilliant guy, but let's move on.
But they still haven't recovered from Brexit. I think that's quite clear. They're still in turmoil since then.
Yeah, and Liverpool is number one, right? So in London, they're just said they don't want to buy anything anymore until a London club is on number one.
Yeah, no comment. That might not be too long. Let's see. Anyway, ETFs. Do you know what? We spoke about ETFs way back in episode 2, which would have been our 3rd episode because we had a pilot episode in the very beginning. And we're going to talk about European ETFs, so these UCITS, because we can't, or it's not easy for us to invest in the lovely American ETFs like the SCHD. So we'll speak pretty much about European ETFs. And what's your take? Why would you own ETFs in the first place? Why, especially dividend ETFs?
If you expect dividend growth, to be very honest,
it didn't take you long.
that's a bunch of shite.
So just for context, before this, we were doing our show notes, and you must have a list of 18 tickers of ETFs, and you were going through, and I could just see you getting more and more annoyed every time you're looking at the dividend growth and what's happening with it on each of them. But I mean, personally, I said it to you, unless you have access to SCHD, I don't believe you're investing in dividend ETFs in Europe for dividend growth. It's more of a total return play, in my opinion.
Yeah. So we can stop the show now.
Yeah, that's it. That's it.
It's really a shite.
Yeah.
I mean, shall we also complain about the European Union now and why they have this KID, this information document for us? Like we're treated like a bunch of children. It's really, really unbelievable. Just because an effing document is missing, not registered, we can't get proper exposure to wealth creation, and we need to deal with inferior stuff.
Yeah.
It's unbelievable. And then that expense ratios. I mean, 0.4, 0.5. What the hell is going on here? I mean, it really, really, really sucks.
Yeah.
I mean, this is the moment you really feel ashamed being a European citizen.
It's literally a 3-page document, and it has a number between 1 and 7, and you rate the risk of the ETF. I mean, that's it. That's why we can't invest in US.
I mean, which European clerk has invented this? I mean, imagine you go with your suitcase in your hand, you step out of the train in Brussels, you walk to your big block ministry, and you think, what am I going to do? Let's piss off all the retail investors in Europe for the next 2 decades. I mean, damn. I wish I knew the name of the person.
I'm glad you don't. For your own sake.
Yeah, but this really sucks, right? And then brokers need to comply with this. And I know there are these loopholes that you can maybe, on SCHD start buying some put options, get them assigned. But I mean, guys, what are we talking about here? It's crazy. It is really, really, really crazy.
It just alienates us in terms of fees. So these funds, that these unit trusts can increase their fees compared to some of the big names. And
yeah, but we're doing it on ourselves. Our European economy, it's I mean, in some countries is just going downwards, south. Same mentality, like really a poor man's mentality. And then we put this shite on ourselves. We just can't do proper wealth creation. If you want to make your life easy and just automate the hell out of it, and you enjoy passive income, they're just doing everything just to torture us.
Yeah.
It's really a torture.
I could imagine many Europeans reading The Simple Path to Wealth. I don't know if you've read that, but it's a nice book, and it's about automating your investing in ETFs. And I imagine you read that and you're all excited, and then you realize what Europeans can invest in, and it just drains every bit of joy out of your body. So.
But is it then on the first page saying like, but if you're a European, please stop here? It doesn't apply to you?
No, it doesn't. It should come with that disclaimer, but it doesn't.
Yeah.
It doesn't.
It's unbelievable. I mean, but honestly, for ETFs, you should just go for a total return index, and then just go for the 4% rule. Yeah, if that's the case, and then you just need to sell from your ETF and live from that money. I mean, then I also wouldn't go for a dividend ETF like distributing. I would just go for accumulating if you're interested in dividends. But I would then just take the highest, best performing index, whether it's a world index, whatever it is that you believe in. Yeah. But okay, let's do an attempt. Yeah,
yes,
let's do an attempt and to see if we can find any bright star among all this Yeah. Stop.
We start with some terminology first, because you mentioned dividend leakage before the show. And
Yeah.
I think that's quite important, because we talk about ETFs, and they are mainly based in the Netherlands and Ireland, I believe. There's probably others, but I think those are the main two. And Ireland and the Netherlands have two different tax treaties. Pretty much with Ireland, it's 0%, because whatever.
Yeah.
It's 0% if you're not me, if you're not a retail investor living in Ireland, but it's 0%, and it's 15% from the Netherlands and 30% in the United States. And because you got different tax treaties, you can have paying too much tax from one because of this leakage. So, which is why I think many people prefer investing in ones that are based in Ireland, because there's no tax, and you don't have to worry about that. Obviously, you can claim tax back and so on that you're owed, but it's still a lot of hassle to do so.
Yeah. So I think it's just what people need to be aware of, because effectively you have double taxation. Then first on the ETF that is being taxed for the dividends, and then you're also again taxed on the dividends. So I think this is just really, really important to be aware of. And just watch out for. And it really depends, I believe, on your tax jurisdiction there. So I think it's just something to be aware of. Yeah.
Okay, let's go through some ETFs, and will we start with maybe the best one that we could find? We'll start there, and it is VanEck Morningstar Developed Markets Dividend Leaders UCITS ETF. That is a mouthful, but the ticker symbol is TDIV. And look, let's go through the top 10 holdings first of all, and let's see how many of these you would probably invest in or not invest in. But they've got Verizon as their largest holding, which is nearly 5%. Chevron Corporation, HSBC, which is a bank, Pfizer, Roche Holdings, I don't even want to say it, but International Business Machines, IBM, Bristol Myers Squibb, Total Energies, Allianz, and Gilead Science. What do you make of that, first of all, before we look at?
Well, I think a proper list. I mean, there are a few stocks in there that I wouldn't want to own, but they're just known for proper dividends, proper yields. Those companies are needed if you want to have an average yield of 4.1.
Yep.
I find the expense ratio a little bit high on the almost 0.4%, right? So, but okay, it's not too bad. Just don't expect too much growth on it in terms of dividends.
Yeah,
because your top 10 is here about 35%, and Pfizer and Verizon and Roche, Total Energies, they are not really hiking their dividends a lot at the moment, in the last few years. So, but other than that, strong total return, I would say, generally for such a boring ETF, and I think it's pretty well designed. So, I like VanEck probably as one of the most ones at the moment. What is, of course, what people of course need to be aware of, like I looked at the 5-year CAGR and I see it's 5.4, current yield is 4, so you have kind of the Chowder rule of 9.54, but it's because it comes of a low basis, this relatively low basis calculation. Also in 2023 the dividend was higher, it was €1.80 in total. In 2024 it was 168. And this is probably important to mention, that you will see this a lot with the ETF. So if you are a purist like me when it comes to dividend income and you don't like dividend cuts, I mean, with these ETFs, all that we are discussing, they have regular cuts. Some more than others. I think it's really good to look at what 2020 did to many ETFs. If you saw a big drop there or not, it gives you a bit of an indication what you can expect in the future. So.
But as you said, from a total return perspective, it was nearly 20% last year, and that is with a dividend cut, which is okay, and an average of say 11.67% over 5 years. So I mean, this was the best that we could find, and the dividend growth on it although it seems like it's good at nearly 6%, we can see that there's been a dividend cut, and it's kind of flattish over the last 3 years. We had 180, then back down to 168. So I think that's the main problem we probably have with ETFs, is that predictability around income. You don't have it as much. And
Not as a European.
Not as European. And the trend we see is over the last 4 years, most of the ETFs will cover their dividends are flat.
Yeah, that's what's really interesting. We were looking at all the charts.
Yes.
And really, it's like 2021, 2022, 2023, 2024, almost all flat.
Yeah.
And how is that possible? Because our portfolios have been chugging along 4-6% each year. So
big dividend hikes.
Yeah. So where is this? Where is this distribution going? Because that's the issue, right? Sometimes it doesn't necessarily mean that the ETF is passing on each and every dividend directly, right? Because what you are getting is a distribution out of the ETF, not necessarily always 100% the same as the dividends they accumulated. Yeah, there's some capital gains sometimes. So, but for me, this is really awkward to see so many ETFs with 4 years of flat dividends, while all our portfolios have been organically growing, and we own many of those shares that you see in those portfolios.
Yeah. We're trying to come up with a valid reason of why that would happen.
I have no clue.
We don't know.
No clue. Maybe a listener knows it. What's going on there? But it's really, really awkward. And maybe the models that they had to. That there were some dividend cuts that hit the portfolios there that kept the dividend flat, because most of those indexes because what these ETFs they follow an index, and this index may not care about dividend safety. It may just look at it has dividend growth for the last 12 months or 5 years. And that's what, and maybe a reasonable payout ratio, whatever it is, or the highest yields for not more than that payout ratio and a market cap of this. But then it doesn't say anything about dividend safety. Maybe it has something to do with that they just had too many dividend cutters in the portfolio.
Yeah. Who knows? But it's we struggle with that. But what about number 2 on the list? Vanguard, FTS, all world. It says high dividend yield, UCITS. Okay, so that's what it says, and it's high. Wait for this now. It's high dividend yield. It's 3.03%. Come on, give me a break.
We're really being scammed here. That's unbelievable. And the expense ratio 0.29, right?
Also. Which is cheaper than the last one, right?
Okay, we got to give this to Vanguard, but Vanguard is the one that wants to have how is it, expense ratios of 0.1 or less, right? So not for us, for Europeans, of course.
No, screw us.
When it comes to medicines, Americans subsidize European drug prices, but I think we subsidize American ETF expense ratios here.
Yeah, 100%.
So if anyone ever complains to you from America that we are the reason why drug prices are low, just remind them about their 401ks and that they should be happy with low expense ratios, because we're paying for it.
From a total return perspective, this high yielding portfolio did not perform as well as the last one. It was 16.34, which is probably not bad, but not as good as tracking the S&P 500. Are probably going to be way behind. So you don't even win from a total return perspective here. But look, I think their top 10 holdings is similar in composition as the last one. They've got a mixture of banks, energy, pharmaceuticals. JP Morgan is their top. The only thing I'll say is their top 10 holdings is only 12%, whereas the last one was a lot more heavily weighted. But JP Morgan, ExxonMobil, Home Depot, Procter & Gamble, Johnson & Johnson, but they're all nearly 2%, less than 2% of the overall fund. There are 30% in financials. Industrials is second at 10% in consumer staples. So it's probably a little bit more balanced than the first one. But as you can see, that diversification is probably taken away from your total returns, which seems to be the case. In terms of dividend growth and dividend CAGR, our high yielding one, 3% yield with a 8.19% 5-year CAGR, which gives a whopping 5.46% shareholder.
Yeah, I rest my case.
Yeah, it's quite. Look, it doesn't get any better. We might have one near the end, which has potential, but it doesn't get much better. And the Spider S&P Global Dividend Aristocrat, UCITS, ticker symbol is GBDV. And this one has a dividend yield of 3.72%, but its expense ratio is the highest of the three. It's 0.45, nearly 0.5% in expenses. But its total return over the year has been 28.9%, which I don't know if that's on par or probably nearly better than tracking the index. Its top 10 holdings, I don't know how many you will know, or at least how many I know, as Highwood Properties, never heard of them, KT&G Corporation, Onex, ONEOK Incorporated, LTC Properties. They have got Verizon.
They've got Solvay.
They've got Solvay, Getty Realty, and Boston Properties. But look, they are a little bit more heavily weighted in real estate and utilities than the other two, and primarily in the United States. But Canada is quite high. Also, the UK is quite high as well. So that would be a difficult one for me to invest in because I'm not
5-year CAGR of.
Oh, come on. What is it? 1% or something, is it?
0.44.
Zero. Come on.
Yeah, it is. What a shite.
Yeah. I think it's clear. You're not investing in this for dividend growth or dividend income. It's not an income investor's one. It's total return.
But why would you then go for global dividend aristocrats?
I don't know what the long-term return is, but over the past year, it's 28.9. If they could hit 20% over 5-10 years, then
okay, cool. And we know that dividend aristocrats generally, as an index, perform really well, and over the years typically outperform the S&P 500, right? Because it's not just because it's a dividend, because those companies, they are typically demonstrating continuous EPS growth and cash flow growth. Otherwise, they couldn't pay those dividends. Yeah. And there are many holdings in the S&P 500 that are just struggling. So you are typically talking here about high quality blue chip, albeit a little bit slower, but growing companies. Yeah. It is what it is. Look, in my opinion, right, if you're talking about this, you could also go for a high yielder than just. So, for instance, the iShares Emerging Market Dividend UCITS ETF, ticker symbol SEDY, it has a yield of 8.17%. You know, you get to own a lot of Chinese stuff and everything. It comes in an expense ratio of 0.65. It's a lot. So your net yield would be 7.5% yield. 5-year CAGR at the moment is minus 1.2. So it will be a chowder of nearly 7. But at least you get income.
Yeah. You get income, but probably do not know one thing about what you own. You're betting big on China. Like it's like an emerging market for all the world.
Yes, of course. Yeah. There's another ticker there still maybe that is worth mentioning is FUSD, Fidelity US Quality Income.
Yeah.
And if you look at those, right, those have also really a lot of good holdings. Yeah, we're talking about the Apples of this world are in there.
Microsoft, I think.
Yeah, exactly. And yet it has at the moment still 5-year CAGR of 8.17. But this 8.70, don't be misled with that, because that's only because it comes from a very low base in 2019. But next year this will drop to 3%, and the year after, with the current setting, it will be even a decline, because the dividend was 21 cents in 2021 and 20 cents in 2024. Yeah. So again, and we're talking here about high quality companies. They've been all growing their dividends, at least they're in the top 10. So it really, really makes no sense. I'm checking here. So the number one position, 7.7% of the entire ETF, Nvidia. 7.4% Apple, 6.6% Microsoft, 2.7% Broadcom, Eli Lilly 1.8%, Visa 1.6%, and it goes down. But MasterCard, Home Depot, Verizon, Procter & Gamble. How come that the dividend is flat? It makes no sense to me. Really, really no sense.
Yeah.
We're talking about 35, 40% of the weight in the top 10 and no dividend growth?
It makes no sense to me. No, unless they're retaining a lot of the cash and reinvesting it, buying more shares. That's the only thing that I can think of. I don't know what the payout ratios are actually. Just ETF is not straightforward in showing that, but maybe that's the trend to look at. What are they retaining? What cash are they retaining?
The only good thing is about FUSD, it has a really good total return history. So in 2018-19, 31%, the year after 12.3, then in 2020-21, 25.7, then almost 11% decline, but then 18% last 2023, and then last year 17%. So it is really a compounding ETF, but for the dividend, I don't think it's really interesting. It gives a 1.8% yield, so that's what you need to do with. And the dividend is not growing in the last 4 years. And so I really, we're just a bunch of retail investors, right? Maybe there's someone that's listening that works at an ETF provider like iShares or VanEck or Fidelity or Vanguard and can explain a little bit more about it, because it has dividend in the title. Sometimes it has dividend growth in the title. It has Aristocrats in the title, but then you don't see it bottom line coming back in the dividend income.
Yeah. I think the titles are misleading. Well, they're not misleading because it's probably the type of companies that they're investing in. But maybe someone that's new to this would see high yield ETF and invest in it because they believe it's high yield, and it's clearly not. But yeah, let's go with one more before. I think it's clear from an income point of view, we're not the biggest fans. And actually, I think we would be better getting someone on the show that invests primarily in ETFs and give us some ETFs that would be good from a expense ratio and total return, and maybe not an income, but maybe just to give our listeners a better flavor.
As long as it's not an income investor, because in the mood that I'm today, I would roast that person.
Yeah, but it is late. We'll do it early, so you're in good mood. It'll be fine.
Yeah.
We'll manage that. But one more, I think WisdomTree always is one that is mentioned, and I think what's your thoughts? WisdomTree quality, I think.
Yeah, but it is a current yield of 1.2% or something like that.
Yeah.
Dividend growth 5-year CAGR of 2.6%. So I know it's often mentioned. It has really good companies in there, the same like FUSD, but then I would go for FUSD.
Yeah.
I mean, please, when you're listening, challenge us. I mean, we're just frustrated. I'm Dutch, so my Dutch directness also kicks in this stuff, right? And then being annoyed makes it even worse. Just challenge us if you believe that there are good ETFs that have a growing dividend, because that's what we're looking at. Then tell us and correct us. After a night of sleep, I may be really reasonable again, but at this moment in time, what a shite.
To be fair, we usually do get challenged, which is good, so we don't really have to ask. But yes, please do it. I'd be curious to know myself. Let's move on to some questions and see if they can cheer you up a little bit, okay? And we'll start with one from Auntie. And it's, if you are starting to build a 5% yielding portfolio from scratch and had 1 year to complete it, how would you prioritize your investments, assuming the market conditions are similar to now? So specifically, if both low yield, high growth, and high yield and slow growth stocks have attractive valuations, would you start with one over the other?
I think you answered that already last year, right? You mentioned you would start with some higher yielding stocks to get used to the income, right?
Yeah, that's the way I would. And I mean, the first sentence there, if you're starting to build a 5% yielding dividend portfolio. So I think for me, it makes more sense to start with high yield there. You're not going to get that with Microsoft, Apple, UCITS, or any of these kind of low yield and high growth stocks. So if your target is 5%, you have to start with a higher yield, slow growth. But yeah, for me, starting out, if I have that kind of a goal in 1 year, I would start with higher yields. Definitely.
Yeah. I would try to find for this unique combination where the 5-year CAGR, the compound annual growth rate, plus the current yield is kind of above 10%. Yeah. So let's say a 5% dividend yield and 5% annual growth of the dividend, reasonable payout ratio. Also the prospects of having EPS continuing that trend, I would look for those. And you will probably only find 10 stocks in the stock market or something like that that qualify for you. And that's enough. Yeah. You don't need 100 stocks. You just need 1 or 2 to every month, to have something to buy.
Yeah. And when I say high yield, I don't mean go out and buy 10%, 9%, 8%.
Yeah.
I would probably stick around the 4 or 5 if you can, but maybe 4%. And
you could add some insurance companies, some European insurers, right? Like an N Group, ASR. They have still proper yields. Maybe Allianz is also near that category.
Yeah.
Then you could maybe think about some utilities that pay 6%. You can take a tobacco stock here and there, and you quickly start building a core. You just need to know that you're investing then in some sin stocks that come with generally lower multiples and all this kinds of stuff. On the other end, some of them are truly cash flow machines.
Yeah. You want to look at the balance sheet and obviously you say cash flow, that enough liquidity and turning a profits into enough cash flow.
Yeah.
That's what I would look for. So yeah, I think it's hard to look past insurance in Europe at the moment. It really is, and this is like the second year in a row.
Yeah.
They're that sweet spot. That's probably where I'd start. Yes.
Yeah, and we have some real estate investment trusts in the States. So think about realty income at the moment.
Yeah. Yes, actually, that's coming up quite a bit. It's under a lot of pressure. Yoval has asked us a question about real estate investment trusts. Went over a dozen REITs and even more, so a good few, and compared the WACC, weighted cost of capital, against the ROIC. And what they noticed is that the difference for all of them is negative, which means it's destroying value. So he even looked at this from a historical perspective. How do you explain this, that this is consistently happening with real estate?
Yeah, because I really believe we're not applying the right measures here. So he's talking about the value creation, right? It's the gap between return on interest or return on income, ROI, let's say, return on investment minus what the cost of that investment is, and the difference between that is what we call value creation, added value. And I really think you need to look here at REIT specific things like the cap rates and such. I don't think it makes a lot of sense to look at return on invested capital in a business like this. So.
Kevin has said that you've published a 4.5% organic growth figure for 2024 in your annual report. Is around 4.6, so your portfolios have some overlap. But based on your published holdings, not more than 30% of an overlap. So what he's wondering is this range, this 4.5 to 5%, to be expected in a diversified portfolio? So would you expect that?
I think he is bringing a good point there, and I was reflecting that on as well. I've got like a 6% target.
Yep.
Yeah, so I was reflecting on that as well. I only hit it once in the last 4 or 5 years. I haven't made up my mind on that one yet because, for instance, this year I had Bayer with a dividend cut in there, which impacted the income. So as long as I still have somewhere from the old days a stock that bothers me, and maybe that's the reality, because I think I'm making so many less mistakes than I used in the past, and buyers still like heritage, history and such. And it doesn't happen to me anymore really with the stocks I'm buying over the last 2-3 years. Maybe Enegas was a surprise, and I think surprises will happen sometimes. So yeah, maybe it's right. Maybe 6% is a little bit on the ambitious side, but I'm not giving up yet. So maybe the reality is what Kevin is saying, but I'm not giving up yet.
Yeah, I think it depends a lot on type of companies, because we stay away from a lot of the low yielding high growth. And I think if you're towards that end of the spectrum, you maybe should expect a little bit higher, maybe 6-7%, even 8% could be more realistic. So
look, for me, it's like portfolio yield is 3.7 for me, something like that, and then 4.5. Yeah, it's a bit too meager still. It's 8.2 Chowder, and I'm aiming for 9 plus. So it needs to go up a little bit still for me. Yeah. So either I need to just go more into higher yielded stocks that are still growing 5-6% and have a bit more of weight in that in my portfolio.
Hans de Jong has asked us a fun, thought-provoking question. You both receive an inheritance of 50,000 from a listener. Very, very welcome. However, it has 2 conditions. You both need to invest it in a turnaround company that you can never sell, and you cannot pick the same. Who will it be?
This is such a... Hans is a funny guy. I like him. He's often engaged on Twitter. Look, it's anyway. It's inheritance from listener, right? Yeah. So he means with that, like, he puts additional pressure that it's not our money.
Yes.
Oh boy,
are you going to call Nike a turnaround play now?
yeah. Well, in my opinion, it isn't. But no, what is a turnaround? What is a real turnaround? So. Buyer is not even a turnaround, it's just dead. Intel, no. Then I would, does Viatris classify as a turnaround?
I don't think so.
But they sold their biosimilars and everything, and God knows what they're going to do. No,
I wouldn't class them as your typical turnaround.
No. So what would be a good turnaround today? I mean, Walgreens, but
nah, they popped. They popped.
Yeah, I saw 25-27%.
Maybe someone like VFC in the long run. Yeah. Maybe over the long term. I know they had some good brands.
What about Medical Properties Trust?
That could be considered a turnaround. I don't know, that's it's a tough question, but it depends on what you call a turnaround. Lots of people will call it. Do you know what? Someone like 3M could be considered a turnaround play if they could sort out their litigations.
Yeah,
you'd have that.
Yeah, but Johnson & Johnson then as well.
Yes, you're picking Johnson & Johnson as your turnaround play.
Yeah. Well, if we talk about litigations. Yeah. No, I really wouldn't know. I would probably just. Yeah, we have to, right? So if I really, really had to, and I consider the value of the underlying assets, even knowing that's heavily loaded with debt, I would go probably for Bayer. I think if Bayer would start spinning off businesses, I wouldn't be surprised that those individual parts are really quickly already covering the 20 euros it's trading for now.
That's it. Interesting.
Yeah, but I would also not tell that listener who I am. I would definitely not give my address, and I would go to church every Sunday to pray.
So you pick Bayer. I think I will stick with VFC. I think they could potentially turn it around. So that's who we would go for. We will take the 50,000, no problem, but we just won't tell them what we invest in.
Exactly.
Dividend Controller, what are you currently reading?
I'm finishing the Income Factory. I'm almost done.
Okay. I'm reading a non-investment book. It is a crime book called Reykjavik. It's obviously based in Reykjavik. It's
okay. Iceland,
yeah. Like, good book. If you're into crime series or crime books, it's a nice book. Richard Taylor has asked me about a new position in Aberdeen Income Investment Trust. I don't think it's a new position. I've held it for about 6 months or maybe a bit longer, but maybe I haven't spoke about it. But he's asking to clarify which one it is and why I selected that particular one. So the ticker symbol is AEI on the London Stock Exchange. And I picked it because it had a high-ish dividend yield. It was 7%. Its policy is to grow its dividend in line with UK inflation. And it also invests in some of the smaller and mid-cap UK companies that I typically wouldn't pick on my own. And there's some nice companies in there. So that was the primary reason for picking that trust. So again, AEI is the ticker symbol if you're looking for that. Anders has asked us about our thoughts on Eton. So ticker symbol ETN. It's sort of an ABB or Schneider Electric in the US. And what are your thoughts?
Yeah, I know the company as a name because I often looked at it when analyzing dividend announcements or something like that. But for the rest, I really have never looked into it, so I can't say anything meaningful. I'm sorry, Anders.
Yeah, I noticed. I heard this company through Dividend Growth Investor. He published or talked about it a bit in his newsletters at one point. But anytime I look at them, they're always low yielding. And again, I look at them now, they're 1.09%. So I never seem to take it any further than that. But I'm not aware of them as much as I am of ABB and Schneider in that field. So I don't know the products or what they are. So I don't know. It's hard to know.
Yeah.
Dividend Stockpile, Jeremy has asked us, what is your current opinion on Schneider Electric? Is there anything US investors should look out for with them? They seem great.
I think you're the engineer here, right?
Yeah, engineer my freedom. I really like Schneider Electric. I think they are primed for growth. They talk about that a lot in their annual reports and these mega trends that they are going to be jumping on. And look, I wholeheartedly believe in, I'd say 90% of those trends. I think they've done a lot of acquisitions and they're in a good place to take advantage of that. What to look out for? One, they're French, a French company, so maybe the taxes are a bit higher. I could see you laughing there. There's lots of competition in that space as well. Look, we have Siemens, we spoke about ABB, Rockwell is close to the US as well. I honestly think they're a really, really good company. I'm waiting for my fair value price to come in. I can't remember what that is off the top of my head. I have a deep dive on it, so I'd have to reference, but it's
don't hold your breath. It's yielding 1.4%.
I know.
It dropped 2% today, by the way, but from its all-time high. So it's still very.
It's miles off. It's miles off where I need to be. This was a company you would need to be buying maybe 4 or 5 years ago when it was in transition. And
2020, before COVID, it was trading at around €100, 90, €100. Then it dropped all the way to 70, and now it's at 250.
Wow.
Yeah.
70 during COVID. Wow.
Yeah, it almost quadrupled.
Yeah. Thanks for that. Dividend Collector. You made a post on Pepsi on Twitter, which got some interest actually about your shrinkflation. And Dividend Collector agrees with your analysis. He stepped away to other brands a long time ago. In his opinion, Pepsi has limited pricing power. When does a dividend king like PepsiCo become too attractive to ignore? So we're talking about nearly a 4% dividend yield.
I was thinking about the same. So I own Pepsi. I'm not selling it. Yeah, don't get me wrong. I was on Twitter more like trying to give a bit of a bearish view because I see everyone just almost hand over fist saying, I'm buying it. And I'm just wondering, like, why is nobody talking about, the recent quarterly report where there was a decline. Yeah, year over year, they can't hike prices easily at the moment. They have been doing shrinkflation. So, and I think that triggered a lot of discussion on Twitter, and also actually a lot of people that also thought it. So I guess many people just are not replying with those thoughts to those other tweets, which is all about like buying Pepsi. Yeah, but that's okay. To answer the question, I expect not a 6 to 7% annual dividend growth in the upcoming years. Yeah, so I think it must be at least a 5% yield for me. I haven't done due diligence yet. I know you have done some due diligence for the upcoming newsletters, so that will be available then on Sunday. But I think at least 5%, but something like that.
Yeah, do you know, I don't really like these questions. When does something become too good to ignore? I really don't, because I feel like you're focusing on the wrong thing. And there's a guy on Twitter, and I'm not going to call out who it is, but every time I see a post, it's one of these companies. We talked about 52-week lows there earlier, and it's one of those companies. Is it too cheap to ignore? And I'm like, it's the wrong question to be asking. Completely the wrong question. Is it backed by numbers? Like why is it dropping? That is how you know when it's too attractive to ignore. If it's dropping and it's based on future guidance being lower than what's expected, but it's still growing, well, maybe it is too cheap to ignore. But if it's dropping because numbers are dropping, revenue is down, payout ratios are too high, debt is too high, then is it too cheap to ignore? I don't think so. I think you're maybe falling into a bit of a trap there. So I can understand sometimes dividend growth investors get a lot of stick, particularly from growth investors or even Bitcoin investors, because sometimes we focus on types of companies that are seemingly dying because they have a high yield, and I can understand frustrations there. So I think it's the wrong question to be asking, in my opinion. Stock Junkie, private equity. Do you own stocks that are managing this? How much should we take into account? What kind of risks? For him, it's too complex to do a deep dive. So maybe there's an ETF out there.
I don't think I own any.
Yeah, I think I'm not sure of many of the investment trusts. Maybe some of the investment trusts that have some portions in them, but I mean, I don't know how to answer that question. Private equity, I don't own any directly. So if I was doing it, I would prefer to do it under a managed fund where there's a manager that knows that a little bit better, a lot better than I would. So yeah, I don't know. Like you, Stock Junkie, it is too complex for me to do a deep dive on. So keep it simple, I would say. Gordon has asked us if we've ever looked into a ticker symbol called HASI. It's a nice play on the energy transition.
No,
I haven't either. I think they are involved in like renewable energy and all that. But again, I've been looking at Brookfield and Nexstar Energy, which is an investment trust. So I don't need to diversify too much now. And Iberdrola, of course, which is the three that I want to own. Terry Spoonface, any analysis on why UK shares are being battered?
I think we spoke about it in the beginning, right?
Yeah,
it's probably more like the whole sentiment around the UK economy.
Yeah. Politics and weak consumers is not a good mix.
No.
Ecoriv, thoughts on T. Rowe Price at the moment? Does it still have a place in a DGI portfolio?
For me, yes, but it's going through a tough time, simply because of the assets under management. It faces some competition from low index fund investing. It's moving into that space. I mean, there's a pristine balance sheet, so I think it's good. But I mean, I wouldn't say if you want to go for lots of dividend growth at the moment, then this is the place to be. I think I don't expect too much in the upcoming 1 to 2 years from this company in terms of that. Some moderate hikes, that's what I expect, and that's about it. And that's okay. It can figure itself out in my portfolio.
Yeah. I'm not too worried about T. Rowe Price because of their balance sheet and how
exactly.
That is. So they've bought themselves some wiggle room, I would say. Tom has said, looking forward to the next episode. Would love to hear your thoughts on the company Sunoco Products. Are you familiar with the company? Is it a company or sector you could invest in? I looked at them maybe a year and a half ago, and it just kind of fell off my radar a little bit. They are a super company. They have really strong dividend history. I don't know what it is. It's a 40 years or so on. But I also like a company close to home, which was Smurfit Kappa. They acquired WestRock, so it's now Smurfit WestRock as well. And they're in the same kind of industry, a packaging industry. But I don't think you can go too wrong with Sunoco. The last time I looked at them, they were slightly overvalued. And I think that's all I've been waiting for them is to drop under this $40 range. And we see, but yes, look, I have to do a proper deep dive on them, but they were definitely on my list for quite a while. So I need to do a comparison with them and Smurfit Kappa or WestRock now, and see what the difference is. But let's see. I just want to call out Chow Dawood. He wrote to us on Spotify comments, and would like to be a guest on the show. Now I wrote back, but I think the best way to contact us is by email. Contact either of us, go onto our blogs or on Twitter, even if you're on that. We would love to have you as a guest on the show. Just reach out to us. I just wanted to say that because I wrote a comment back, but I don't know if people get notifications on them or not. And then the last question came on Spotify is, what do you think of Rubis? I think you looked at them before, no?
Yeah, but it's been really a while ago.
Yeah. I remember high depths for high amount of debt on the balance sheet and inconsistent dividends, if I remember, but I don't know.
Yeah, and if that's the case, because they are specialized in storage, right, and distribution and sale of petroleum, LPG, these kinds of things. I know it's maybe not everywhere a direct competitor, but then I would rather opt for Vopak. Yeah, the Dutch one.
Yeah. Cool. We got through all the questions. So thanks again, everyone, for the questions. Some nice ones in there, some thought-provoking ones. Again, on the ETFs, it's not our circle of confidence, I must say. We are primarily income investors, so please, we said, challenge us. If you can, if you like this episode, like us on Spotify, leave us a comment, rate us. It will really help us getting the word out there, and we will see you all next week.